Value investing tries to identify companies that are trading at a discount to their intrinsic value. And some of the top all-time investors have made their fortunes with a value approach. Well, the new pair of actively managed ETFs from Miller Value Partners taps into a unique value strategy. And here to explain and share more is Bill Miller IV, Principal and Chief Investment Officer with Miller Value Partners. Hi, Bill. It's great to see you.
Stephanie, thanks for having me.
So before we discuss your firm's newest ETFs, why don't you familiarize our audience with Miller Value Partners' unique investment philosophy as well as your approach?
Well, I think it's important to start with our history when thinking about the firm because that's where our approach comes from. My dad, instead of just looking at low price to earnings multiples, he would look at addressable markets and potential earnings power 10 years down the road and make big bets on things that other people may not view as quote unquote value names, but ended up doing really, really well and outperforming the market for a long period of time with that approach. And so we still try and take that approach today. We take concentrated positions exclusively in select securities that we think can outperform the index. So we take a very high level of active share. We invest almost exclusively outside of our indices. And the acronym actually we use today for the firm is F.A.T, F-A-T. So we are flexible in our view of value and processes. We're not going to be dogmatic and try and do something that's not working. We're aligned with our shareholders more than most any other active manager you can name. And then we are the largest investors in all of our strategies and have a huge amount of money in them. And also the names we buy in our portfolios, we make sure that our management teams are heavily aligned with us as investors because the principal agent conflict is a real one and incentives drive outcomes. And then the T in FAT stands for transparent. We're going to keep our investors informed of what we're doing on a near live basis and why. So that's the overview of our firm.
Yeah, sounds like a solid philosophy. And of course, it sounds like you learned from one of the best, right? So the Miller Value Partners Leverage ETF and that ticker symbol MVPL and the Miller Value Partners Appreciation ETF, MVPA. These are among your firm's latest launches. Both ETFs are actively managed. Give us a breakdown. Tell us more about these individual funds.
Yes, so we wanted competitive products out there to outperform the market. And when you think about how you can outperform the market, there's two ways you can do it. One, you can manage the systematic risk or the broad-based market risk and what your exposure to that is. And two, you can manage the idiosyncratic risk of the holdings. So you weight what you own in a different way than is what is in the index. Those are what our two ETFs do. One tries to manage market risk and the other tries to manage idiosyncratic risk by taking aligned bets with equities that we view as undervalued and likely to appreciate over the long term from their starting point. The one we're less well known for is that second one you mentioned, the MVPL, Miller Value Partners Leverage Fund. And the idea there is actually we take a systematic approach to managing risk. And we do that using a first principles approach in that you want to be long assets that go up over a long period of time. You actually want to borrow money to invest in those things, so long as you can avoid the risk of ruin. And so we think we have a systematic way of using intelligence, data from competitive markets, efficient markets actually, to manage that risk. So the fund goes between two assets, 1 times SPY and 2 times SPY. So you're always long the market. You're either very long the market or you're long the market at all times. And we attempt to manage that risk on behalf of investors by hopefully cutting off the left tail risk.
With that being said, how do you see both of these ETFs being used by investors and financial advisors when you're talking about a diversified portfolio?
I view them as both core positions in the risk bucket designed to outperform the market. At the time we launched MVPA, which is the concentrated idiosyncratic risk, fundamental value-based approach, its fee was lower than 80% of actively managed funds benchmarked against the S&P. So we view it as a really attractive product at an attractive price point with really strong IP and aligned management team working on your behalf every single day. We also have a lot of money in MVPL, heavily aligned with our shareholders and grinding every day to produce excess returns.
All right. I think that's what investors like to hear. Bill Miller IV, thank you so much for dropping by. It's great to have you.
Thanks so much for having me, Stephanie.